When you first enter trading, you're instantly confronted with an endless amount of information: indicators, price action, fundamentals, macro data, news, risk, position sizing, and psychology. Trying to absorb and apply everything at once is the quickest way to feel lost, inconsistent, and discouraged. Profitable traders do the opposite. They simplify. They don't trade everything. They don't use everything. They focus on a small number of core concepts and apply them again and again. That's exactly what this video is about. In this video, I'm going to show you 5 trading concepts that, when combined, are more than enough to build a complete trading system: market structure, support and resistance, candlestick confirmation, liquidity sweeps, top-down analysis. You don't need more than that. As Bruce Lee famously said, "I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times." Be that trader. Master a small set of concepts, execute them with discipline, and let repetition do the work. That's how trading becomes clear, repeatable, and profitable over the long run. Now that the importance of simplicity is clear, let's begin with the first and most important concept: market structure. No matter what market you trade, no matter what time frame you use, price can only do 3 things: move up, move down, or move sideways. There are no other conditions. Once you can correctly identify which state the market is in, you immediately eliminate confusion and most bad trades. Let's start with the uptrend, because this is where most traders either make consistent money or lose it by overcomplicating things. An uptrend is defined by a sequence of higher highs and higher lows. A simple way to visualize it is like climbing a staircase. Price moves up, pauses, then continues higher again. Each pause forms a higher low, and each push creates a higher high. What does this tell you? It tells you that buyers are in control. Demand is stronger than supply. Buyers are comfortable paying higher prices, while sellers are unable to push the market lower. Now here's a key point most traders miss. Price does not move up in a straight line. An uptrend unfolds in 2 repeating phases. The impulsive move. This is where buyers step in aggressively and push price higher with momentum. The retracement. This is a temporary pause, where some traders take profits, causing price to pull back before the next push higher. These pullbacks are not weakness. They are a natural part of a healthy trend, and often where the best trading opportunities appear. An impulsive move is the strong and decisive push upward that drives an uptrend. This is the phase where the market moves with speed and conviction, and several forces come together at the same time. Here's what's really happening during an impulsive move. Strong buying pressure. Large players, retail traders, and automated systems step in simultaneously, creating aggressive demand. Breakout participation. As price breaks above previous highs, many traders see confirmation of strength and enter expecting continuation. Stop-loss fuel. Traders who were short against the trend get stopped out. Since closing a short position requires buying, this adds extra upward pressure. FOMO behavior. When price accelerates, emotional traders rush in out of fear of missing the move, amplifying momentum even further. This combination is why impulsive moves often look fast, clean, and powerful. Now, after every strong push, the market needs to breathe. That's where the retracement comes in. A retracement is a temporary pullback within an uptrend, not a trend reversal. It happens for very logical reasons. Profit taking. Traders who bought earlier lock in profits, reducing buying pressure and causing price to dip. Short-term imbalance. When price rises too quickly, fewer traders are willing to buy at premium levels, leading to a pause. Better positioning by smart traders. Experienced traders don't chase impulsive moves. They wait patiently for pullbacks to enter at more favorable prices, in line with the trend. This is critical to understand. Impulses show strength. Retracements create opportunity. If you can read these 2 phases correctly, you stop chasing the market and start trading with it. A downtrend is simply the opposite of an uptrend. Price forms lower highs and lower lows, showing that sellers are in control and supply outweighs demand. Just like an uptrend, a downtrend moves in 2 repeating phases, but in reverse. Impulsive move, a strong sell-off in the direction of the trend. Retracement, a temporary bounce before price continues lower. Now let me ask you something. How do you know when a retracement is ending and an impulsive move is about to start? This is where the second trading concept, support and resistance, becomes essential. Support and resistance are not just lines on a chart. They are areas where traders make decisions. Support is where buying pressure previously stopped price from falling. Resistance is where selling pressure previously stopped price from rising. These levels matter because the market remembers them. In an uptrend, impulsive moves usually start after price pulls back into support. Here's what you look for. Price retraces into a previous support zone. Selling pressure slows down. Buyers step back in and defend that level. When price holds support and starts rejecting lower prices, the retracement is likely ending, and the next impulsive move can begin. In a downtrend, it's the same logic, but reversed. Price retraces into resistance. Buying pressure weakens. Sellers defend the level and push price lower. This is not prediction, it's reaction. You're not guessing where price will go. You're waiting to see who defends the level. Most traders try to enter in the middle of a retracement, or late, after the impulsive move already happened. Professional traders wait for price to prove itself at support or resistance, because when a key level holds, momentum usually follows. A range, or sideways market, is when price moves between two well-defined levels, support at the bottom, resistance at the top. There is no trend because buyers and sellers are balanced. A range forms because both sides have limits. Buyers are willing to buy, but only at lower prices. Sellers are willing to sell, but only at higher prices. Neither side has enough strength or conviction to break the other. This creates equilibrium. That's why ranges are dangerous. Breakouts often fail. Traders enter too early. The market punishes